Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. We have had a pretty big turnaround in the equity markets here over the past week or so. So today we're going to break down what we're currently seeing from the markets and what opportunities we want to seek going forward. Before I get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off as usual with our broader market update. Like I said, we've had quite a reversal here over the past few trading sessions. I want to talk a little bit about the breakout that we have seen in the equity markets. We certainly have resumed this bullish trend, but are there any concerns that we see with this market? We want to highlight those, show you from a volatility perspective what we're currently seeing, how that translates into some of the views that we have from the overall market, and then taking a look at everything from commodities and rates to give us a better understanding perhaps of how the equity markets are currently pricing risk on, risk off. Now, I think because of the performance that we've seen over the past couple of trading sessions, we do want to do a quick FANG review, the FANG stocks, where they currently sit. We do see a bit of a spectrum here when you look at the FANG stocks, similar to what we saw, I would say, about a month ago, right after the initial plunge, right after September. So we want to now do a FANG review now that we've had a month since that initial plunge. We've had some consolidation, and where do they all sit today? And then at the very end, we have a few minutes for some ideas and questions if we have a few minutes for that here at the very end. So let's go ahead and get started. But the primary question that I think a lot of investors currently have on their minds is really, can markets really break out back to new all-time highs given the backdrop of what we currently have? We are about to enter into earnings season. We just kicked off earnings season with JPM yesterday. So the question is really, can markets sustain this rally? Is it sustainable? Can we break out to new all-time highs and continue going higher? That, I think, is the question for most investors at the moment. So we're hoping to try to answer that question. So today, what I'll be sharing with you is my technical research, any economic research that we're currently looking at, as well as my charts to give you a better understanding as to how I'm viewing the current market conditions. So we start off with the Qs. The Qs, the NASDAQ 100 index. We've been talking about 282 for quite some time. And over the past month, after the initial plunge off of that roughly 303 high on the Qs, what we have put in is what I would consider a bit of an inverted head and shoulders. That is, generally speaking, a bullish formation. And especially when you have an inverted head and shoulders after a consolidation period, when you get the breakout here, they tend to be pretty quick. And that's exactly what we've seen over Friday and Mondays. We've had a very quick move to the upside. Pre-market, the Qs are again higher from 294 to 297. So I think that we are now within probably 1 to 2 trading days away from testing those all-time highs and potentially breaking out from all-time highs. Now, if we look at momentum so far has confirmed new higher highs here. And we have accumulation distribution or market breadth confirming these moves higher. So far, this is all supportive of a potential move, a potential retest of these all-time highs and a continuation higher. Now, when we look at the S&P 500, we see a very similar picture. So in this particular case, we have both the NASDAQ and the S&P predominantly in line with each other. Now, the Qs certainly a little bit more tech heavy, a little bit more higher performance than the S&P 500, but the two charts look very, very similar. So same thing here on the S&P. After that, the consolidation period was an inverted head and shoulders. We've had a breakout from those inverted head and shoulders, and we would expect the S&P 500 also to retest those all-time highs here within the next couple of trading sessions. Same thing, momentum confirming those moves higher, and market breadth also confirming those moves higher here. So both the major indices, the NASDAQ 100 and the S&P 500, reversed higher. Now, the fact that they've broken out from this consolidation phase puts us into much more of a bullish tone. So what we have here is bullish tone, consolidation, back into a bullish tone. That's what we're currently seeing with this market. Now, the question really, I think, for most investors is not, are we in a bullish market, but really, how long can this last? So let's take a look at a few other things. When we look at small cap managed to break above a very significant level, 160. We've been talking about 160 for a very long time, where it acted as resistance many, many times, and recently just finally broke out above that 160 level. Now, we did have a confirmation from accumulation distribution on that breakout, so this is a confirmed breakout. So what we might see is a little bit of weakness, but a continuation higher here and retest that 170 high, which is the high from back here. 170 is the next major resistance level here for IWM or small caps. Small caps has been a strong performer here over the past couple of weeks, and we generally see small caps outperform during the recovery phase of a recession. And arguably, if we certainly, I think many investors would consider us to currently be in that recovery phase of the recession that we just went through, a very short recession that we just went through. Whether we're still in that recession or not, I think is debatable. But with GDP numbers now positive, this certainly would put us back into an expansion territory. So small caps generally tend to outperform during this time. So this is one where it is supportive of the equity markets and the broader rally that we're currently seeing when you have small caps rallying alongside the mega cap names. That is the healthy part of a rally that you want to see. And when you see just a few tech names continue to drag the markets higher, that is a sign of an unhealthy market. We did see some signs of that yesterday, where predominantly it was just a few tech names dragging the markets higher, while small caps and IWM were largely flat on the day compared to the NASDAQ 100. Yesterday, IWM was about 0.6%. Equal weight was up 0.7%, but the NASDAQ was up over 3%, and the S&P was only up about half of that, 1.6%. So we are starting to see these signs of somewhat unhealthy market tops, where you just have a few big names dragging the markets higher. That's why we want to take a look at the FANG names here today. When we look at the equal weight S&P 500 index, this is where we saw a lot of strength here over the past couple of weeks. That momentum is starting to slow down a little, especially as it starts to approach overbought conditions here on the RSP. But confirmation of that breakout, we did get that confirmation of that breakout as well here. So we do expect equal weight indices to continue moving higher here from the market. So this is really where we do think that there's more upside here on the equity markets, but there are some warning signs as far as the health of this market from exactly what we just spoke about. And what we saw yesterday was a fairly unusual pattern. We don't see this very often, and generally speaking, we have seen patterns where when this happens, that is generally when markets are near this kind of complacency tone, that there is a potential reversal on the horizon. And that is when the NASDAQ 100 index and the volatility index that tracks it moves in the same direction on the same day. So yesterday, the NASDAQ was up about 3%. The VXN, which is the volatility index for the NASDAQ 100 index, was also up. Normally, they have an inverse relationship. When the market moves higher, volatility moves lower. But when you have the markets move up so high, 3%, and the volatility index also moves up a little bit, didn't move up too much, but moved up a little bit yesterday, that is an unusual pattern. And that is something that we saw also during the September highs, right before the September highs. So this is one of the things that is somewhat concerning to us, is during this recent ramp up, we saw some days where when the markets were up, volatility was up as well. And we're starting to see that same parabolic move a little bit on price action. And yesterday we saw the volatility index move higher along with the price index. So this provides a little bit of a warning. The only thing I want to say is that when this happened last time, the Qs moved substantially higher first before it plunged back lower. So this in itself does not warn us that there's a pending reversal here. But when you couple it with a few other things, such as just how strong call buying has resumed again. So the put call ratio was 0.56 yesterday, so a significant amount more of call buying than put buying here. A lot of investors have bid up, if you will, the implied volatility of call options as a result of this, and that explains some of the increase in volatility despite an increase in the underlying index itself, where you have an increased amount of call buying, and this generates a higher implied volatility and drags volatility higher despite the fact that the markets are moving higher. This is generally a complacency signal. This is, generally speaking, not particularly healthy when you have such extreme call buying that's not matched with the same number of put buying. So this also is typically signs of near a market top. Now, can the markets continue moving another 5 or 10% higher before they reverse lower? That's the key here. Just because you see these warning signs does not mean that a reversal is necessarily on the horizon immediately. It could materialize a few days, a few weeks, sometimes even a few months later in some extreme cases. So that is certainly one place that we are paying attention to here on these market rallies, because it has gone a little parabolic and we have seen some of these warning signs. So when it comes to gold, this is really where we've seen a lot of wavering back and forth in terms of gold. Gold was sitting above this 180 support level for quite some time, but broke below that a couple of weeks ago. It's managed to get back above that 180 level. And the question is whether this is ready to start resuming its move higher here. This is certainly one place that we are paying attention to, because the inflation expectations or inflation concerns never really went away. Gold kind of just consolidated for quite some time. And if you draw your charts maybe a little differently like this, you can think of this as kind of a consolidation flag, and we're now starting to break out higher here. So multiple ways to draw this chart that suggests that the decline in gold here is perhaps over, and we're perhaps ready to start to see a bit of a rally here from some of the precious metals, especially as we see base metals continue to rally across the board. We have aluminum, we have copper rallying fairly strongly, and now we're starting to see a little bit of strength here from the precious metals. So this is certainly one place that we're paying attention to. Now, when we look at fixed income, this is really where also very similar outcome. You have HYG, the high yield fixed income ETF. It has stayed above this $84 level, or 84 has been a fairly major line in the sand for quite some time, but recently broke below this level. That gave us more of a risk-off environment. That was why when the markets were consolidating, we were a little concerned about the stability of the markets and whether they can actually break out from that consolidation range and continue to move higher. We now have the answer to that question, and in conjunction with that, when the equity market started to rally, we saw high yield get back above this $84 major line in the sand here. So fixed income markets giving us some confidence here that fixed income markets are resuming their inflows into some of these higher yielding, riskier assets, which is generally speaking a good thing, again, for equity markets to rally, because this is telling us that investors are more on a risk-on environment, and the fixed income markets is one very important set of metrics or indicators to pay attention to as to where investments are flowing in and out of within the fixed income space. But we also see treasuries remain fairly stable, meaning we saw 10 and 20-year yields pop up over the past couple of weeks that have now started to stabilize. So we brought this up a couple of weeks ago, but I want to bring this up again because TLT has now reached the 200-day moving average again, and so far has held that 200-day moving average. And our expectation is similar to HYG, after breaking below that support level, is perhaps starting to resume back into a more of a bullish trend here as investors continue to find continue to look for some safety here from treasuries, especially since there's really not a lot of other places to park your cash if you have some cash sitting around, and there does seem to be quite a bit of cash sitting on the sidelines that are not being invested. So that's providing a little bit of support here for TLT or some of the treasury bonds. So fixed income across the board, we're seeing support levels either being held or resistance levels starting to break to the upside, certainly telling us there's much more of a risk-on environment that the equity markets are telling us. So One of the big things here is that fact that we've kicked off earnings season. JPM came out yesterday. Their revenues actually rose by 4%. They've, their profits were quite a bit higher above consensus from what analysts were expecting. And I think the big news was really just the amount of new funds they were setting aside for their loan book that they were expecting in terms of losses on loans. And that was a particularly strong, I would say, confidence booster in terms of the turnaround here for not only the economy, but also JPM as a bank. So I will say that the earnings numbers were fairly strong. The response to that was, I think, fairly muted. The market, JPM was up less than 1% here, pre-market here, and it's still trading below its 200-day moving average. We did see some bigger moves from some of the other banks, like Goldman Sachs, on this news that JP Morgan beat earnings, because now I think the street expects some of the stronger names in this particular space, such as Morgan Stanley, Goldman Sachs, to actually start to outperform. And perhaps this could be the catalyst that turns around or stems the outflow, if you will, from XLF, the underperformance of the financials and the banks. Is this the catalyst that turns things around? Perhaps that's what we're going to pay attention to here over the next couple of days. But we have banks with earnings this week, very likely to follow similar templates to what we saw here for JPM. So with that, what I wanted to take a look at are the FANG names. So, NASDAQ up 3% when the S&P was up 1.6% and the Dow was up less than 1%. That's a fairly unusual circumstance to see such a large difference in terms of performance between the major indices. So with that, from my perspective, it makes sense to take a look at the individual high or big components, if you will, of the NASDAQ 100 index, which is predominantly the FANG names. So I wanted to take a look at the big names, and some of the ones have news, or some of the ones have more relevant news to pay attention to, such as Amazon. Amazon's Prime Day is today and tomorrow, a very, I would say, important indicator for investors to pay attention to get a better sense of just how retail sales is doing, especially going into the holidays. We do expect that the holidays is going to be quite different because Black Friday, a lot of stores are trying to avoid those crowds in Black Fridays because of the coronavirus. They are trying to spread out their sales. They're trying to do different tactics. So the end of this year shopping is going to be a little bit different. So Amazon pushing out their Prime Day from their usual July dates out to October, providing us with a little bit more insight into just how strong consumers are, or lack thereof, if there is any type of gains here. So one thing I want to point out is, before yesterday's breakout here, higher here on Amazon, Amazon was putting in what I would consider a head and shoulders topping formation, and we would look for a breakdown below that $2,900 level, which it never came. We ended up breaking to the upside, and what that does is it invalidates this head and shoulders formation. Especially if it can get back above those all-time highs, then Amazon would certainly be back on its way to new all-time highs and a continuation there. So Amazon, out of the FANG names, actually one of the strongest names. It's invalidated its head and shoulders, resuming its bullish trend. I would expect here over the next day or two, just like the Qs, to potentially revisit those all-time highs and see if it can break out higher. If we can break out higher, that would certainly put the equity markets, in my opinion, in a much more bullish state, rather than the slightly complacent tone that the current market has placed itself in. When we look at Apple, this is another stock with a major news announcement today, which is predominantly the new iPhone 12 being launched. This is the 5G iPhone 12. This is, part of what's going to bring the whole Apple ecosystem together between laptop, phone, and tablet. At this point, the phone and tablet are kind of in its one ecosystem. The MacBook Pros or the computers are in its separate ecosystem. Apple's continuously working towards having a single chip across all three devices, so that all three devices can effectively run the same apps, the same ecosystem, and the same type of operating system. And this is something that Apple's been working on for quite some time, especially as you talk about their AR ambitions. iPhone 12 is a big part of that. The chips that they have produced, moving away from Intel, allows them to do this. So this is also another one of those stocks that has broken above this or completed what I would consider this inverted head and shoulders pattern and is now headed back into those all-time highs. This is one that has gone, a little parabolic here. So be careful in terms of continuing to push for upside here. From my perspective, if you're going to play for further upside here for names like Apple, take advantage of the slow decline that we've seen in implied volatility on these types of names. They're just a little bit less elevated, so you could potentially look at buying some call verticals, some call debit spreads. Buying some premium is the right environment, in my opinion, to continue play for further upside, because when you do see further upside in these names, they tend to be very, very quick, especially with the amount of complacency that we're currently seeing with this market. So you could see some very quick moves to the upside. Buying call options are suitable. Even some slightly shorter dated options that give you a little bit more time premium, but a little bit more gamma, can potentially be beneficial in this type of market environment. But when you look at the major FANG names, there are still a few names that have not completed or have not invalidated that head and shoulders pattern. So if you look at Facebook, it still very much has a valid head and shoulders pattern here. Can this break out to the upside? That's what we're going to see here today. But it could also fail to the downside and complete a head and shoulders pattern and move to the downside here. So this is one that we're paying attention to out of the FANG names. Like I said, a wide spectrum here on the FANG names and what we're currently seeing. Apple and Amazon breaking to the upside. Facebook not as strong, but perhaps will invalidate that to the downside, to the upside here today. Netflix also, as you can see, Netflix is a bit of a triple top here around this 550 area. It hasn't managed to break back above 550 for multiple times. It failed here yesterday. So this is one that we're also going to pay attention to. Netflix largely has been pretty much range bound between this 475, 550 range here. So the question is whether Netflix is going to start just trading its way down to that 470 level and then start making its way back up here again, or if it can break out. Because one of the things is that Netflix has had declining momentum here on these moves lower. So perhaps now it has a little bit more of an extra momentum to get to that breakout here to the upside. So both Netflix and Facebook on the verge of major breakouts. So pay attention. You could see a continuation higher, especially if technology remains strong here over the next few trading sessions. Another one I wanted to take a look at that's really a little unconventional, which is Clorox. Clorox, largely, very strong performer here since the beginning of the coronavirus, strong bullish trend, but has spent the last roughly two months or so consolidating here to the downside after what was a very strong run. As you can see, pulled all the way back to the 20-week moving average and is now starting to create this bottoming formation here to the downside. So this is one that we're paying attention to for a potential reversal. Now, this is one where you want to take advantage of the fairly elevated implied volatility that we're currently seeing with this market and see if you could sell some premium, sell some 210 puts, buy back maybe a 200 put, sell a credit spread so that as long as it stays within this range or moves a little bit higher, you'll be able to profit from that type of trade. So Clorox starting to find some support, starting to turn around here, potential turnaround candidate here for the broader markets. So as you see rotation into tech and you see some of these more parabolic moves, you want to make sure that you have some opportunities both in more defensive plays like you see here in Clorox and Staples, and some of the more higher riskier trades like technology that can potentially take off very quickly over the next couple of days and maybe just end it there with just a few days of strong performance and then start to slow down a little. We've seen that a lot over the past few months. So those are the ways that I think that I would be looking at playing or spreading my opportunities here within the markets, not just focusing necessarily just on tech, but looking at some of the banking names, which we have seen some strong earnings. I would focus on the stronger banks like Goldman Sachs and Morgan Stanley, with JP Morgan as kind of our template. And then looking at some of the technology names for the potential breakouts like Facebook, Netflix, and also at the same time, look for some defensive plays in Staples and even consumer discretionary. Consumer discretionary, also one of the sectors that invalidated that head and shoulders here over the past couple of days. So those are ones that I would pay attention to here for the broader markets. And lastly, Microsoft. Microsoft also invalidating this major head and shoulders pattern. As you can see, this is what it was putting in. It recently broke out above that right shoulder here. So Microsoft, for the most part, breaking out or invalidating this huge, I would say, consolidation period. I think that's what we should call this. You know, after a very strong move to the upside, it consolidated for quite some time and now started to resume its move higher here. So this is another tech name that I expect over the next couple of weeks to retest those all-time highs around 233, 234 on Microsoft to the upside. So that is a quick review of the names that we're currently paying attention to. Oh, whoops, I have one more. Google. Google, similar to Facebook. As you can imagine, their business models are almost identical from the perspective of they are both advertisement. Most of their revenues generated from advertisement. This is really where Facebook and Google are still looking like they have this head and shoulders formation that they have not broken out from yet. So this is one that I'm paying attention to because Facebook and Google having the exact same pattern is a bit concerning to me as far as the you know, whether or not these two names, which is a little different than Apple and some of the other names because these are advertisers versus hardware companies, that the fact that we're not seeing the same type of strength here from these advertisements speaks perhaps a little bit more to the you know, how investors are viewing the shape of this recovery and how much advertisers are going to spend going forward. Clearly not as strong on that thesis as they are on perhaps the hardware business for Apple, the retail business for Amazon, and perhaps the streaming business of Netflix. Facebook and Google telling us a slightly different picture, a slightly more cautious tone here to the tech names from these two perspectives. So that is currently how I'm viewing the markets, what we're paying attention to in terms of opportunity. I hope that this is helpful in giving you a better understanding as to what our current market outlook here is and where we see some opportunities. With that, I want to thank everyone for taking the time out here this morning. I hope that you guys find this useful, and I'll be seeing you guys here next week to keep you updated again. Thank you so much and have a great trading day.